Hi guys, this is Aditya Vora here. Over the past 2 years, the hospitality industry is on a roll. Be it airlines, hotels, and restaurants, the rush is insane. Apart from the fact that the occupancy levels have even crossed the pre pandemic levels, the pricing is off the roof. I mean, 3-star hotels are quoting the prices of 5-star hotels at tourist locations. An air ticket from Bombay to Calcutta is the same as an air ticket from Bombay to Dubai or even Bangkok, as a matter of fact. Domestic travel along with luxury accommodation has been growing extremely fast. Let me throw some numbers at you. Indian Hotels, that is Taj, recorded its best operating margin in its history. The average room rate is close to the highest at Rs 10,740 per night with operating margin of 37.6%. The occupancy in fact has reached 75%, which is the best in a decade. Lastly, the profit of the last quarter was more than the entire year's profit. Isn't that great? This is the case with most hotel stocks and all of them are sitting at record profits. Unfortunately, the stocks have also tripled from the bottom and are trading much above their average mean. In my view, doesn't make sense chasing such stocks at such prices. While I am sure the demand is robust, however, the risk reward for a fresh buy at these levels doesn't look favorable. In that case, let me talk about a stock from a similar theme which is financially better than most of the hotel stocks. I am talking about the theme park space. Now, this space was badly hit due to COVID and has come back sharply just like the hotel stocks. However, the stock I am going to talk about is much superior to the hotel stocks when it comes to its operating dynamics and debt levels. The stock I am talking about is Wonderla Holidays, and in this video I will tell you why I prefer this stock compared to hotel stocks or any other reopening or revenge consumption stocks. For starters, for people who don't know about Wonderla Holidays, Wonderla has 3 amusement parks located in Bangalore, Hyderabad and Kochi. It also owns and operates a resort in Bangalore. Now let's analyze this company on 3 aspects. First is the operational parameter and where it stands. Second is the business potential going forward, basically why I like this stock. And lastly, the valuations and what the way forward is when it comes to risk reward. So when you talk about business parameters for a theme park, you should monitor these 3 parameters. The first is footfalls, which is the most important. Then comes the average revenue per user, which is nothing but the spends which a customer does by buying a ticket and also spending money for food and other add-ons inside the park. And lastly, it is the EBITDA margins. Also, please note that since FY20 and 21 and even some part of FY22, theme parks were closed across India due to COVID. For comparing real growth, let us consider footfalls for the 9-month period ended December 2020 and corresponding 9-month ended December 22, which is the last quarter. So let's start with the most important metric for a theme park, which is footfall. Footfall basically is the number of people which attend your park. In manufacturing terms, it is the volume growth for the company. For the 9 months ended FY23, Wonderla had the highest footfall in the history of the company. It crossed the magical number of 25 lakhs in just 9 months this year, which is a growth of 27% as compared to the corresponding pre-COVID period. All the 3 parks contributed to the strong growth, which tells you that this trend is secular throughout the country. Also, business models of theme parks have a high operating leverage. What I am implying is that fixed costs like electricity cost and personnel cost remains same irrespective of whether there are 10 people in a ride or there are 50 people in the ride. In this case, as the footfalls grow, profitability grows faster as fixed costs are spread on a higher base. Now the second important metric is the average revenue per user or ARPU. The 9-month ARPU was at 1263 rupees, which grew by 14% from 1100 rupees, which was pre-COVID. Now this ARPU is broken down into two things. The main component is the average ticket price, while the second small component is the average non-ticket revenue, which is the amount spent on food and beverages and other paid attractions in the park. The average ticket price varies from location to location and is the most sensitive amongst all parameters. For Wonderla, if you look at Bangalore, the average ticket price was roughly rupees 1000, while the average non-ticket price was 330 to 340 rupees. Now if you look at Kochi, which is a tier 1 city and not a metro like Bangalore, the average ticket price drops to 850 to 870 rupees, while the non-ticket revenue is at an average of 260 to 70 rupees. While Hyderabad is somewhere in the middle, as you can see in the slide. So from an analytical standpoint, it is relatively easier to get volume growth if things are broadly fine. A lot of people told me that the pent-up demand or revenge travel lasts for 1 year maximum. Well, if you look at the hotel industry and the theme parks, it is not pent-up demand but sustainable demand which is driving growth. In my opinion, the real challenge for the management is to increase ticket prices, as that is the most sensitive factor. There are two ways to look at Wonderla's ARPU. One is that over the 3-year period, the average ticket prices has gone up by 12 to 14%, which is moderate as it implies 4 to 5% increase per year, which is in line with inflation. However, the other way to look at it is that increasing ticket prices at the same pace before from here will be a very challenging task, as rupees 1250 is already at a decent pricing. Any adverse increase in ticket price will hit demand and footfalls first. Now the third parameter to look at is the EBITDA margin, which is a function of the above two parameters and certain costs like power and manpower. Wonderla has achieved an EBITDA margin of 51% for the 9 months as compared to 46% of the pre-COVID period. In fact, the EPS is the highest in the history of the company. So friends, now that you are aware of the operational parameters of the company and its impact, let us look at the business case for Wonderla. Two things which matter in this case is one, forecast and sustainability of the superlative performance which the company has seen, and second thing is the expansion plan. That is where the delta in growth will come from. When it comes to the sustainability of performance going forward, let us break it down for footfalls, ARPU and EBITDA margins. I believe the demand trend is strong and footfalls historically during the pre-COVID period have grown by 4 to 6% annually. Considering this time the company is doing a lot of initiatives which I will discuss later, along with new rides being added, the footfall can grow by 7 to 8% at least for the next 2 years. Now when it comes to ARPU, the real delta is from non-ticket revenues, and I'll tell you why. Let's assume ticket prices grow by 2 to 3% max every year over the next 2 years, but the non-ticket sales in my view will give the delta in ARPU growth. What Wonderla has done is that it has started a new vertical where the company wants to position its theme parks as a destination for thrill and parties. It organizes concerts in its theme park which range from sunburn events to New Year parties. This not only leads to a higher footfall but also increases the ARPU of the company. Wonderla plans to increase the frequency of events and also organize small events every weekend. This model in my view is likely to boost ARPUs and non-ticketing revenues going forward. So in that case, let us assume that ARPUs grow by 4 to 5% over the next 2 years. Also, a point to be noted is that Wonderla has a 84-room hotel in Bangalore in its theme park, which has a total occupancy of 76%. This could also contribute to increase in ARPU and revenues going forward. So in my view, that leads to roughly 15 to 17% revenue growth on a very high base over the next 2 years till the new theme parks come in. Also, the EBITDA margins which we are seeing are at an all-time high margins, and there is no way the company can sustain these margins at 51%. While pre-COVID margins have been 40 to 42% on an average, I think going forward 45% could be a decent and achievable EBITDA margin. Also, when you talk about growth, Wonderla is going to open a new theme park at Odisha, which will be half the size of the Bangalore park in 2025. Also, they are eagerly awaiting for permission from the Tamil Nadu government to start construction for their Chennai theme park, which is going to be as large as their Bangalore park. Once the permission is received, the Chennai park can become open to public within 1.5 years. These two parks can meaningfully add revenues from 2025 onwards. Also, Wonderla is like the undisputed leader in the southern cities which it operates due to its scale and type of rides which it offers. Wonderla keeps on adding new rides in parks and keeps the consumer interest high. So, in terms of competition, it is like a virtual monopoly. Now, to end this, let me talk about the most important aspect, which is valuations. This slide shows the assumptions I have made for the next 2 years and logically where earnings can grow over the next 2 years. Please do understand that these are my assumptions and I can be horribly wrong with these. So friends, to end this, let me conclude by saying Wonderla is a debt-free company with majority of future expansion also likely to be done by internal accruals. Also, the company is innovating with tech by testing variable bands which reduces time for entry exit along with giving options for purchases via the variable device along with ride queue management. While the company since listing hasn't had a great run, the past 1 year the stock has risen sharply. So friends, thank you for watching my video and do let me know in the comment section.
Thank you for tuning into Equitymaster's YouTube channel. If you enjoyed this video, we've got many more valuable investing ideas for you. Click the link in the description to access them now.